Hi, everyone, and welcome to our special Made for YouTube series. I'm Sumaira Abdi, and today we're going to talk about credit risk funds. And I do realize that this is a category of funds that we've ignored for a good part, of the last year. But it has been seeing some interest from high risk investors, and there have been some substantial inflows as well coming into this category. So I thought it would be a good idea to, once again, just figure out what credit risk funds really are and what they mean for your portfolio. I mean, will 2022 provide certain opportunities for investors who are looking at credit risk funds? So joining me, I have Devang Shah, who's a co-head of fixed income at Axis AMC. Hi, Devang. Thanks very much for joining in. Now, what we know about credit risk funds is basically just the definition that minimum 65% must be invested in below the highest investment grade, right? So double A plus and below is what the bulk of the investments would be. Can you help us understand exactly what credit risk funds are beyond just this definition? What kind of securities do they invest in, and are they really as risky as it's made out to be?
Yeah. So thanks. See, from a perspective on regulations, you rightly cited across that AA and below investments in credit risk funds is mandatory to keep around 65%. But from an overall perspective, what fund managers do in credit risk category, so to just give you some overview first, is that in fixed incomes, generally there are three levers of generating returns. The first aspect is the duration aspect, which is played through long duration funds and generally long corporate bond funds and long GSEC funds are the flavor for duration funds. The other two aspects which helps in generating returns for fixed income funds is one is the credit and the second aspect is liquidity. The liquidity is again very simplified in the shorter term aspect, which are the short term funds, which is your money market, ultra short term, low duration and liquid fund categories. The credit is the third aspect. And what do I exactly mean by credit risk funds? The credit risk funds is where most of the investments in the fund is invested in corporates which are AA and below rated. Now, if you look at the rating scale, from a rating perspective for corporates, we have a AAA rated, which is the highest quality rated corporate, and you go down all the way up to triple B. The triple B is the investment, triple B minus is the investment grade. Up to triple B minus, you can have issuance of securities. In India, when you look across at issuances from corporate bonds in the format, where would you lie the maximum issuances? It will all be in the triple A centric. You will have some bit on double A and double A plus, but very, very few in single A and below. So most of the issuances in corporate bonds in India, I think if you look at the proportion, it would be around 75% plus in triple A, 20 to 25% in double A minus categories, and 5 odd percent in single A's. The general credit risk fund tries to pick up a larger portion of investments and invest in NCDs or bonds issued by these AA and single A rated corporates. Again, when we looked across at payers as well as industry in India, the entire investment generally happens in the AA centric. So I would say large proportion of investments happen in the AA category. These are typical 2 year, 3 year maturity bonds, and generally they offer you anywhere around 100 to 200 basis higher yields as compared to a AAA bond of similar maturity. So that is how the construct of a credit risk fund happens in India, and probably most of the payers as well as us would be running approximately around 2 year, 1 to 3 year instruments in AA rated bonds and invest in such securities in the credit risk fund.
But Devang, is there enough in terms of a universe of securities in this double A, bucket? Because while I understand that you can go all the way to triple B minus, but I mean, I would assume as a fund manager, you'd want to still stick to as high a grade as possible, right? So, are there enough opportunities, and what does 2022 hold?
See, I think from a perspective on AA issuance, as of now, actually AA issuances are they have significantly matured. The market has significantly matured over the last 3 4 years. Yes, we had that credit crisis or a credit downturn from 2018 to 2000, I would say mid 2019. But post that, I think again issuances have started increasing. Last 1 year, due to, I would say, thanks to COVID and this general uncertainty, people sitting on a lot of cash and liquidity, I think we have seen little less of corporate bond issuances. But I don't see a challenge in corporate bond issuances in the double A category. We have lot of sectors. We have also issuance. A larger issuances also comes from the finance sector, the NBFCs. So from an issuance pattern perspective, yes, I don't see it as a challenge for the current size of credit risk fund, as well as if the credit risk funds increases. So if you look across 2 years back or 2.5 years back, credit risk funds total AUM as a category was more than 1 lakh crores. At that point of time, also we didn't see any kind of challenges in the deployment as well as number of issuers. So that is not a worry. As far as the credit quality goes, you are right. I think most of the funds, and at Axis specifically, if I spell out our investment policy, we don't invest anything below single A category. In fact, the investments in both are across wherever the accrual funds are there, which is credit risk fund for us, the investments largely are in double A oriented securities. Most part of it, a smaller percentage, around 5 to 10% would be in the single A category. So that is how the fund construct is there. When I look at the industry also, a larger portion of investments happen in double A category only.
But now, Devang, the regulator has mandated that this category will go into this very high risk category on the riskometer. So, therefore, is the risk reward justified for the investor to invest in it? I mean, you'll get what, 24% in terms of your annual CAGR, but you're investing in a very high risk category. Wouldn't you just be better off taking that money to equity?
See, I think how does it, just to make some understanding on credit risk funds. So, first of all, these are double A rated corporates. Double A rated corporates, NCD issuances of 2 year, 3 year. If you look across at their general yields in India, today your 2 year triple A corporate bonds would be trading at closer to around about 5.5%. When you're looking at a double A corporate, the general yields on these papers would range, obviously depending on the sector, underlying corporate, as well as the overall financial strength of the corporate. But the general range would be around 6.5 to 7.5% band for a 2 year, 3 year double A oriented corporate bonds. I think this, from a nature perspective, NCDs and bond investments cannot be equated with the volatility as well as the end investor. What when you're owning an equity versus a debt, I think there is a lot of difference in risks. When it comes across to a debt investment, when I look across at it, you are still secured. When it comes to a worst case scenario, an insolvency case, or if the company goes bankrupt, NCD which is secured is significantly in a waterfall mechanism, stands significantly higher and can see a lot of recovery as compared to equity, which gets completely written off. So I think from a risk reward perspective, first of all, and double A oriented NCD cannot be compared with a similar investment made in a company in equity. Secondly, I think from an yield or a return expectation perspective, I think the return expectations are significantly different. Yes, we can say that generally a positive growth cycle, which augurs well for equity, also augurs well for credit. But when it comes to an overall investment as well as the seniority of debt versus equity, debt is significantly senior, as well as when it comes to the, as I explained you, to an insolvency or a bankruptcy case, an NCD holder probably gets much more. And we have seen it in various options. Like you have seen the recovery for debt holders in various default cases in the last 2, 3 years versus an equity. Where equity will see a complete write off.
So, what kind of high risk investors would need a credit risk fund? And, where does it fit into the portfolio? What should be the kind of allocation that it needs?
See, first of all, how we advise credit risk funds, okay, is that the thought process for us has been twofold. One is a macro approach. Like credit funds, as I explained you, the credit, it's very much linked to the credit cycle in India, as well as what is happening on the credit cycle globally, because now we are quite interconnected to the globe. But most importantly, it is top down macro driven. If the growth cycle is positive, generally it augurs well for credit cycle, and generally it is far much better for credit risk funds also. So it is a direct correlation with the growth cycle of the economy. If you are doing good on the growth, I think probably that's a good time for investing credit risk funds. The second important element which we need to advise to investors is that this is not the AAA oriented funds where generally you're taking a rates view. Here, what is a credit risk fund is where you are actually underlying investments, or the view is on how the corporate balance sheet would behave, how the sector would behave, and how the overall economy would do for an uptick in credit cycle. That is when you make money or you get good returns in the credit risk funds. So I think that difference of or that approach difference, as well as that understanding among investors, should be very clear, that as compared to rates where you have more there you don't have any kind of credit risk, there you're taking a sovereign exposure. As compared to that, here is the underlying exposure on the corporate, and hence it is advisable for investors who generally are looking at some kind of additional returns over the general safety options. The general safety options are for like tax-free bonds. Some people target FDs. I think if an investor is looking at a return which is 2 to 2.5% higher as compared to these products, and who is okay with those kind of credit volatilities and understands credit risk, these products are actually meant for those kind of investors. So two basic themes. One, before investing, I think the most important element is that you need to understand where the macroeconomy is heading towards. A positive macroeconomy is good for credit risk fund. And secondly, it is for well-informed investors who understand credit volatility. And the target and expectation of returns is that 2.5% higher as compared to a normal conservative option.
Okay. And your house view is that 2022 would be a favorable year for this category.
See, here 2022, if you have heard us, I'm sure we have spoken before also, Sumaira. I think we are positive on the growth outlook. I think we are not as bearish as RBI, nor we are as bullish as what the equity markets are pricing in. I think somewhere the truth lies in between. But from an overall perspective, I think if I look across at the efforts which RBI and government has put across on growth, as well as on overall addressing this entire COVID cycle, as well as the 2 years before that, this entire mess around liquidity and NBFC. I think they have done a superb job to ensure that we don't have any kind of accidents. Lot of liquidity getting pumped in, ensuring that credit flow happens to the stress sectors in the last 2 years. Now, COVID is almost 2 years. So, to ensure that credit flow happens and we don't see any kind of accidents, I think they have taken very good steps. When I look across at the view forward for growth as well as our outlook, I think economy, there is actually good demand, strong demand coming across from all centers. Yes, there are certain sectors which are COVID linked and which are more where you need to go out. I think probably they will continue to see some kind of volatility and stress. But overall, on a macroeconomic front, we believe that these are good times, and somewhere down the line, from a risk reward perspective, because growth cycle is positive, spreads are attractive, credit risk funds do continue to make lot of sense for investors. I think last year credit risk funds have been the best performing category across fixed income funds.
Yeah.
I believe even this year, probably if you look across at, even if we don't get any kind of credit compression, I think just the simple carry gap, the yield difference between a triple and a double A fund, I think for a retail investor, it still makes lot of sense to enter into credit risk funds, because these are running, the most of the pairs are running very low duration, so they don't have any huge interest rate sensitivity. They are just pure carry accrual products. And with the underlying understanding of good macroeconomic environment, it does makes a lot of sense to invest in credit risk funds in 2022.
Okay. And Devang, since we're talking about credit risk funds, one of the aspects which came to the fore was this thing called segregation, right? Side pocketing, as we know it. Now, more or less, issues have been resolved, but there are still, some, I think, 200 crores worth, which is in side pockets across eight segregated portfolios. But I mean, this is a concept that I think investors would do well to understand before they take the leap, right? So can you just explain exactly what is segregation, and what is this side pocket, and is it really a cause for alarm?
So see, I think once, what does side pocketing means is that somewhere down the line, once if there is any kind of, do you anticipate that any kind of default or any kind of significant impact on a underlying credit is going to happen, rather than the entire fund getting impacted, and you see, we have seen it in cycles where at times you see huge redemptions, and then you see a lot of impact on the investors which are left out. I think what SEBI has come out with a very, very good measure is that when you envisage as a fund manager, as a fund house, or generally if you have started seeing deterioration in a credit profile of a company, what you do is you take that exposure, side pocket it. It is just example, if I have 100 rupee of investment in 10 securities and one security gets into some kind of trouble, the rest of the 90 rupees as well as the investors don't suffer for the rest of the 90 rupees. They will continue to get the accrual, investment, everything the way it is. You don't see any kind of volatility there. 10 rupees, which is probably going to see some kind of stress or probably can see a default, is segregated into a separate portfolio, separate NAV gets released, and hence the overall impact on the fund as well as for the investors who are staying in the fund remains very, very muted. So it runs like a two different funds where 90 rupees is business as usual and the 10 rupees gets segregated into a separate portfolio. Supposedly, if you see any kind of deterioration or any kind of great impact there, the impact will be limited only to that 10%. That is the whole
And
idea
then
of
return
segregation.
once the recovery is made.
Yes, and sorry to add that. Yes, it's a very fair point. So as soon as the recovery comes, again, it is not being distributed among the investors and who have left or who have come after that. It is just that the 10 rupees, the recovery also comes, gets allocated to that investors who have stayed aside, and whatever recovery comes goes to those investors. So it is probably, I would say, segregating the good portfolio and some part of the portfolio which is showing stress to ensure that the investors at any point of time don't see any kind of volatility.
Understood. Fair point. All right. Thank you so much for joining in and for explaining, Devang, how a credit risk fund works, and also what is the hope for credit risk funds in 2022, and of course this making us understand also what a side pocket is. So thanks very much for joining in. So I hope this
Thank
has been helpful, and for investors who want to consider it, please do your own research as well, and do remember to check that credit risk funds do fall in the very high risk category. So do make sure that you align it to your own risk profile. Thank you very much for watching. Stay safe.